Now we're gonna dive deep into the world of investing where two names reign supreme, Warren Buffett and Peter Lynch. Let's unravel their secrets one by one. First, meet Warren Buffett. When you think of investing, chances are Warren Buffett's name pops into your head. Known as the Oracle of Omaha, he's one of the wealthiest people globally. His secret lies in a strategy called value investing. Buffett scours the market hunting for what he calls cigar companies. These are companies that seem like they're not worth much, but with a little bit of care, they can turn into treasures. Take for instance, Coca-Cola. In 1988, when Buffett started buying shares in Coca-Cola, the company was struggling. Its stock price was falling and investors were losing faith. But Buffett saw an undervalued gem. He knew that Coca-Cola was a brand that people loved and that it had the potential to bounce back. His investment strategy was based on the belief that the stock price would eventually reflect the company's true value. Today, Coca-Cola is a multi-billion-dollar business, and Buffett's investment has paid off handsomely. Now let's talk numbers. Value investors like Buffett focus on fundamental analysis. They dig into a company's financial statements like a detective looking for clues. Key indicators like price-to-earnings ratio, return on equity ROE, and dividend yields are like breadcrumbs, leading them to hidden gems. The PE ratio, for example, tells you how much investors are willing to pay for every dollar of a company's earnings. A lower PE ratio could signal that a stock is undervalued. Return on equity measures how much profit a company generates for each dollar of shareholder equity. A high ROE suggests that the company is efficiently using its resources to generate profits. And finally, dividend yield shows how much a company pays out in dividends relative to its share price. A high dividend yield could indicate that a company is mature and profitable, making it attractive to value investors. These ratios, and more, help value investors spot companies that are priced lower than they should be, allowing them to make smart investment choices. Now, the second star of our story, Peter Lynch. Peter Lynch is a legendary mutual fund manager who gained fame in the 1970s and 80s for his remarkable track record. Unlike Buffett, Lynch wasn't a fan of analyzing financial statements. Instead, he had a unique approach. Lynch had a simple philosophy: be greedy when others are fearful. While this might sound counterintuitive, it's been proven to be extremely effective. Lynch believed that the market often overreacts, sending both great and terrible companies plummeting in price. His strategy was to identify companies poised for significant growth and invest accordingly. Take, for instance, the computer industry. As personal computers started gaining popularity in the 1970s and 80s, Lynch identified this trend early on and invested in companies that were riding the wave. One such company was Dell, which he invested in before it went public in 1986. By the late 1990s, Dell was a multi-billion-dollar giant, and Lynch's investment had skyrocketed. Another example was Microsoft. Lynch bought shares in Microsoft before it became a household name. He recognized the potential of this software company, and his early investment paid off big time. Now, let's talk about growth investing strategies. Growth investors prioritize rapid expansion and market share growth. They look for companies that are changing the game, often in emerging industries. Unlike value investors who rely on financial statements, growth investors read newspapers, follow industry trends, and attend trade shows to stay ahead of the curve. They spot companies that are disrupting industries and invest early, riding the wave of innovation to potential riches. Now, let's look at the differences between value and growth investing. Here's a table breaking down the key differences between value and growth investing. As you can see, these two strategies differ significantly in their approach, metrics, and investment goals. Now, let's play a fun game. Let's say you have $10,000 to invest. Which approach would you take? Here are two scenarios to help you decide. Scenario uno, you find a company called Sunny Side Up Foods. They produce organic eggs. Their financials are solid, but their stock price seems low compared to their earnings and growth potential. On the other hand, you have scenario two. You stumble upon a company called Sky High Drones. They manufacture drones for agriculture. Their financials are a bit shaky, but their stock price is soaring due to the potential of their technology. Which company do you invest in? Do you go for the stable growth of Sunny Side Up Foods or the high-risk, high-reward potential of Sky High Drones? Your choice can give you an insight into whether you're more suited to value or growth investing. Now, What's the verdict? Which approach is better? Well, there's no clear winner here. The best approach often depends on your individual circumstances. Value investing is like a marathon. It's a long-term strategy focused on stability and gradual growth. It's great for those who are risk-averse and prefer a steady pace towards financial success. On the other hand, growth investing is like a sprint. It's high risk, high reward, and perfect for those who can handle volatility and are looking for explosive returns. At the end of the day, the best approach is often a mix of both. Imagine having a balanced portfolio with investments in both value and growth companies. This way you benefit from the stability of one, while still having a slice of the action in the other. So, here's the key takeaway. Whether you lean towards value investing like Buffett or growth investing like Lynch, remember that the real secret to success lies in consistency and patience. Don't chase quick profits or fall for the latest hype. Stay true to your chosen strategy and let your investments grow over time. And here's something else to consider. Investing is not just about making money. It's about growing your wealth and securing your financial future. The approach you take can say a lot about your personality and financial goals. Are you the careful planner or the bold risk taker? Maybe you're a bit of both. Understanding your own tendencies can help you make smarter decisions. Now, I've got a challenge for you. Think about your own investing style. Are you drawn to the stability of value investing or the excitement of growth investing? Let me know in the comments below. And if you found this video helpful, hit the like button, subscribe for more insights, and share it with someone who loves investing or wants to learn more. Until next time, happy investing. Alright, now I want to shift gears and talk about something that can seriously level up your financial game. Credit cards. But hold on, I know what you're thinking. Credit cards. Boring, right? Well, trust me, these aren't your average credit cards. These are cashback, travel rewards, and points cards that can earn you serious money and freebies. With the right card, you can earn thousands of dollars in cash back every year on your everyday purchases. No, seriously, thousands. Imagine getting a chunk of money back on the things you already buy. It's like getting paid to spend. Plus, these cards offer amazing perks, like airport lounge access, free checked bags, and even hotel room upgrades. It's like having a secret weapon for travel. The best part, it doesn't require any special spending habits. You just use your card as you normally would. So if you're ready to take your finances to the next level, click that link right now and get started.